Hello, my name is Joseph Falbo, Certified Financial Planner. Today we're going to talk about the good and the bad of cash. Now, when stocks and bonds have negative performance as they have this year, many investors start becoming really interested in cash alternatives. As a matter of fact, some will say the mantra, cash is king, as we all have heard that, right? This has certainly been the case this year as yields have been increasing to levels we haven't seen in years. So the yields on cash have gone up to yields we haven't seen in years. But as with any major financial decision, it's important to understand the benefits and the dangers of any change in strategy before we act, and we'd like to go through them. So the greatest benefit of cash comes when we view and use it for short-term needs, such as paying monthly expenses, if you have an upcoming car you're looking to buy, if you're using it for a vacation, or the cash is set aside in a checking account or emergency savings account, or sometimes, as we like to call it for our retired people, their war chest. It's not about the yield, but it's more about that being, you're able to access the money if you need it, if and when you need it. When you have an allocation of cash like this for upcoming or unexpected expenses, this reduces the risk of having to sell out of stocks or bonds that are down during that time period to pay your bills. So cash is of greatest benefit when it's used to pay for upcoming expenses, saved in an emergency fund for unexpected expenses, and as a part of an overall investment strategy in your plan with stocks, bonds, and other investments. So those are the benefits. Now let's talk about the possible dangers of cash and how people start thinking of this. When we use it as an investment or a parking spot with a long-term investment portfolio or without long-term goals. Now, while cash does pay a nominal yield, it always produces a negative real return. When you take the interest rate minus the inflation rate, it's usually a negative return. Now, due to its negative real return, cash is usually and historically not a good long-term investment. Now, some investors are tempted to use cash as a parking spot when they experience losses in their investments. While moving to cash does remove that immediate risk of short-term loss and can provide you that immediate, emotional relief, it brings about significantly more risk to your future returns, since cash is usually and historically not a long-term investment strategy. The investor must guess when to get back in. So let's say the market goes up 15% from the bottom. Is it now safe to get back in? What about if it goes up 20 or 30%? The investor has to re-enter the market and then it goes down again. Does the investor move back to cash? And at what point does the investor realize the train has left the station, like in a bull market, and the investor is not on board? You're still in cash. So you get the point. Going to cash in an investment portfolio provides temporary emotional relief and stops the short-term bleeding, but it starts introducing significantly more risk as the investor has now turned into a speculator trying to figure out when to get back in and how long to stay. I hope this message helps you.